Hello everyone and welcome to the Nomad Hedge. In today's video, we're going to look for signs that could suggest a tradable rally is on the horizon starting next week. With the upcoming FOMC meeting, the Fed is set on hiking key interest rates by 75 basis points on Wednesday, the 21st. But despite all this, technicals suggest we could have reached overbought levels on the DXY and the 10-year Treasury yield. Should they start to pull back from here, the market could possibly bounce, thereby initiating a new bear market rally. To find out, let's explore some charts and analyze the price action. But first, if you're new here, consider subscribing to this channel and hit that like button if you're enjoying the content in this video. Starting off with the 10-year, we can see that it's currently trending up after a breakout from a downtrend when it found resistance near the Fibonacci extension level of 0.618. We're almost also reaching previous resistance back in June this year, so all this suggests a corrective pullback seems likely in the coming days ahead. Now, the technical shows us one side of the puzzle. I think the indicators points to a possible pullback. Let's begin by taking a look at the RSI, and as we can see, we're starting to reach overbought levels in a slowdown in momentum. Last time we were this overbought, that's when the 10-year topped just below the Fib extension of 0.618 and continued its decline. Below that, another interesting indicator is the MACD, which gave us a sell signal a few days later. And if we look at the MACD today, we are almost poking with yet another sell signal with declining momentum. So by looking at the indicators, we can clearly see signs that a pullback is more likely ahead, but we can't predict how far a correction would go. For that, we would have to gauge the technicals what happened previously. If we look at the chart, multiple times the 10-year found critical support at the 21-day and 50-day moving averages. Last time, however, the 150-day moving average played a key role. But what if the 21, the 50, and 150 have become weaker with time, and that anything below them would seem possible as well? If we go back to the technicals and look for patterns, the 10-year could be up for a double top formation. Now, a bearish pattern in this magnitude could entail a drop to the 150, the 200, or even backtest the previous resistance levels of 0.5. Another interesting support level would be this high-low trend line going back to the 1980s. Let's also see what's happening over at the dollar index and see if we can find any possible outcomes for a pullback in the DXY as well. So just like the 10-year, the DXY has been in a massive run. We can see a rising wedge has been building up for weeks now, and it seems to have found some short-term resistance over here. So by looking at the technicals, it would suggest a pullback to around 108 or maybe even 107 seems very likely. Although I don't see this rising wedge playing out in the short term before hitting at least 111 and then declining from there. Moving on to the volatility index, and as shown, it's also displaying technical signs of a pullback after finding resistance within a rising wedge as well. Now, I know many would argue the fact that you can't really chart the VIX, but if you look at it on a daily or monthly time frame, you can certainly do that. And these open gaps tend to be filled within 90 days, and we do have a few of them here. So if the VIX manages to go below 25 in the coming days, that would indicate a tradable rally. Lastly, we have the S&P 500. Now, the technicals by itself clearly shows a bullish falling wedge. So if we can fill that open gap and find support just above this lower low, that would also make a perfect timing for a tradable rally, just in line with a falling 10-year and a continued pullback in the DXY. We're also seeing oversold conditions on most technical indicators, so a bounce from here should be in the making the week ahead. If you take a look at this candlestick, Friday demonstrated buyers stepped in the session. So taking all this into perspective, we obviously have the FOMC meeting on Wednesday. The futures market priced in the 75 basis point after the CPI report. Now, the good news is we no longer have to argue about a 50 or 75, but if the Fed chooses to go along with a 50, that could potentially spark a huge rally. Again, I'm not calling for a bull market. This is just in the eye of a short-term tradable rally to raise some cash. Anyways, that was it for today's video. Thank you so much for watching, and if you enjoyed the content, be sure to hit that like button, and I'll see you guys in the next video. Take care.